Jerome Powell and the Federal Reserve Board are friggin' rock stars. Those of you who missed the interview and the speech yesterday, I'm going to summarize a lot of it and get into the details of what he was talking about, but I couldn't be happier with the discussion. So stick around. Good morning. My name is Adam Kahn, and I'm the Rational Investor. Today is Friday, October 20th. I hope you're all excited for the weekend and enjoyed your week this week. I want to get into Jerome Powell's talk yesterday, but before I do me a favor, give a thumbs up, like, subscribe, chime in, make some comments. Let me know if you guys watched the speech and what you thought of it. See if you guys see him as the rock star that I do, or the whole committee, and let's talk about it a bit. The other thing is I'm going to put a couple links in the description as well. There'll be some ability to open an account with SoFi. Gives you guys a $25 bonus if you put in $10 or more. And there's also some opportunities for some other bonuses as well, so check it out if you like. It does also give my son a little bit of a gift, and he gets really excited when people do that, so I think that's super cool, and I appreciate the support. So let's talk about yesterday's Fed meeting, or speech, so to speak, not really a Fed meeting. So I don't know if you guys listen between the lines, but as far as I heard, everything is going perfectly. Like really, even surprisingly to Chairman Powell about they had to raise the rates as quickly as possible to slow things because they were getting out of control. They still have that 2% target rate in mind, which I think is a little aggressive, but it sure made me feel a little bit more comfortable, especially because the stock market's been weak. Housing has definitely slowed again. But I like to talk about housing a lot. I do mortgages as well, but this is our traditional slow time here in Las Vegas. As we start getting closer to the holidays and people focus on family and Christmas and Hanukkah and all the other stuff going on, even Thanksgiving, what ends up happening is people get distracted from looking for homes. Sellers get a little bit nervous. They start to lower prices. But then the year ends and, tax season starts getting underway. And by March, even April, things tend to pick up again. So I kind of wonder if it's just the cyclical nature of what I do and what I watch, along with the stock market being a little weak. Because, to be fair, the 10-year bond pushed to 4.99%. It's really fighting on that 5% yield. It's come off a little bit today, but yesterday it was really attacking that 5%, which is going to be a big psychological barrier. So they did get into not just short term rates, but they started talking about the long end of the curve. And what I found interesting is the Fed has managed to take $1 trillion off their balance sheet. So during COVID, they went from 4 trillion to 9 trillion, which is totally crazy. But they did that as a backstop and to guarantee the economy and make sure things were okay. But from there, they've managed to start siphoning some of that stuff off. Chairman Powell essentially said, he doesn't pay much attention to the long end, but they're one of the big sellers right now pushing the yields higher. So it's interesting that he's saying they don't really pay attention to that end and it doesn't affect inflation. I think it probably does to some degree. I've also read that Japan started selling some of the bonds as well, and this continues to push yields higher. So everybody understands there's an inverse relationship there. As the Fed sells bonds, prices go lower. Lower prices equate to higher yields. So what I think is going on, no matter what they say is going on, I don't know if I'm right, but I really do think this. I think while the Fed is unwinding their balance sheet, that's pushing the long end yields to go higher, and it's beginning to uninvert the yield curve, which a lot of economists associate with a recession. If it does it because the long end is going higher, not because the Fed has to cut rates because they see a recession, I think there's a good chance we don't go into a recession. That they've actually managed this really well, that their predictive models have gotten better and better. The other thing that he got into about it that he was talking about is the delay. They all talk about that it takes 6 to 18 months before the effect of raising rates impacts the economy. What he said that was so interesting is, yeah, that was in the time of Milton Friedman and when they talked about it, but there have been lots of books since talking about how the markets now anticipate these moves and price that in advance in terms of their models of being able to recognize how those changes are going to impact the economy over time. If that's true, what you're seeing is real time updates as to how they think it's going to impact the economy as they raise rates. So it's already priced in, and you shouldn't see the lag effect that you've seen in the past when these things happen, which is why I think we won't have the recession everybody's predicting. I also think that for what the Fed is doing, it's really good that everybody sees a recession coming. One of the things that was talked about is if nobody believes that we're going to really try to get the 2% interest rate, then you see everything reverse. You see inflation become a problem, and you see it becoming that now we have to become even more restrictive than we thought we would originally. Since everybody is beginning to believe the Fed, and what I'll tell you is, in the end, they will win, whether people believe them or not, is that you're seeing the markets now naturally come to this fruition that, yeah, things are going to slow. He said unemployment should go up, but he's hoping only moderately. And they're not going to have to rush the way they did in the beginning because things are taking effect. But they're going to keep an eye. They're not sure if they're going to have to raise in the future or not. And I would argue that at this point, they probably don't have to raise anymore. If they keep unwinding the balance sheet, that'll have the same effect. If the long end of the curve starts to go higher, especially if you see that start impacting mortgage rates the way it had. Last I looked, you know, I tend to look at like Bank of America and some of the others instead of pulling up my own pricing it's easier and their websites are good. So on Bank of America, they're 8.25% on a 30-year mortgage. Now, that is credit scores above 740, putting 20% down, and they're also charging almost a full percent point in cost to get to that 8.25%. Well, that's slowing down the housing market. What the federal chairman talked about was exactly what I've been talking about in some of my videos as well, which is people have low interest rates, so this isn't really affecting them too much, including myself. So if you've gotten in the interest rates, 25% of the homeowners are in an interest rate below 3%. Over 50% are under 4%, and something like 60 or 70% are under 5%. So you have a significant percentage that this makes no difference to them. They're just in their homes and they're going to stay there. That's going to continue to keep the inventory low, which will go to what I keep saying of I don't see any big house collapse coming. And he comforted me that that is not their goal or intent. They don't want to see huge unemployment. They don't want to see a house market collapse. They would like to see it soften, which I think we've seen that. But I think as somebody in the industry, we're going to see it stagnate for a while. And those of you who think that that's some self serving comment, I promise you, I would so much rather see a house market collapse because then we get busy again. It becomes affordable. People on the sidelines step in, especially if the Fed then has to come to the rescue and lower rates and give, like, there's this total misconception about people say that because that's good for them because higher prices and whatever else you think. When I tell you that is so far from the truth, the only thing that ends up better for me personally is the longer it stays slow, the more people will leave the industry and I'll start to pick up just because there'll be less people in the industry. But the higher interest rates and the higher prices have slowed down the transactions dramatically. There's all sorts of videos on that. I kind of think that's where we stay for a while. And if the Fed lands it perfectly, boy, we might stay there a couple of years and slow down as they hope. Maybe similar in the auto market. I mean, Tesla just reported soft sales and they missed on their earnings, which is something that rarely happens. So maybe things are slowing exactly how they hope. And to be fair, the conversations that he had voiced exactly that. Economy is slowing. They were a little concerned about the CPI pushing up a little bit towards the end of the year and getting back up around 3.7 and 3 instead of 3.2. But there were also a lot of things in that data that he was pointing to that he says overall, though, he sees it slowing. The number of jobs per person has dropped from 2 to 1.4 per person. So he sees the labor market softening as well, which is super important to the entire economy slowing down the way they were hoping. So I think they've nailed it. I think they'll get a lot of flack just because they have a tough job and everything else. But I think people are going to continue to complain about how expensive things are. They're going to have to make better decisions about not buying everything and the things they do buy. And you'll see that flow through exactly how they hoped. And hopefully we balance here and just continue chugging along. So don't expect a stock market crash. Don't expect a housing market crash. Just expect things to be more expensive than they used to be and having to, manage the things you purchase. His one concern is the wars that are going on, that it could push oil prices higher if they go on for too long and things like that, and that'll stem through in the inflation. But my own thought is it'll more decrease margins for companies because there's only so much they could have raised prices. If oil prices continue to go up and gas prices go up, the companies that sell the end product, they're just going to have to cover that cost and make less money on what they sell. I don't think they can continue to just raise prices from where they are. I do think people are stressed. So anyway, I hope you liked the video. I tried not to stop it and record all the way through to do one fluid recording. I hope I didn't ramble too much. I tend to do that. Again, I'll remind you, give a thumbs up, like, subscribe. If you have some comments, comment. Tell me where I'm wrong. I love to have the conversations. So have a great day, and I'm sure I'll chime in again this weekend.